Welcome back to the Deep Dive. It is Tuesday, February 24th, 2026. And if you've been staring at your portfolio this morning or just doom scrolling the financial news, you've probably noticed that the vibe has totally shifted.
Oh, yeah, totally shifted. It really feels like the confetti from those big AI hype parties of 2024 and 2025 has finally been swept up.
Right. The music is off.
The music is off and the lights are on, and those lights are bright, harsh, fluorescent office lights. We are firmly out of the promise phase right now. We are now in the era of revenue realization.
Exactly. I mean, for 2 years, the market was throwing money at anything that even whispered generative AI.
Literally anything.
It was all about the demo. But today, investors are looking at the receipts. They are asking, okay, you built a $50 billion data center. Where is the profit?
And that is a terrifying question for a lot of companies because the bill has arrived.
It has. So today we're going to answer that question for the two biggest players in the game. We aren't looking at the scrappy startups or the chip manufacturers today. We are staging a heavyweight bout between the two companies that effectively own the internet.
The Titans.
Right in the blue corner, we have Microsoft. And in the multicolored corner, we have Alphabet, the parent company of Google.
It is the matchup of the decade. Because
Right.
for a long time, these two just stayed in their lanes. Microsoft owned your Office. Google owned your search bar.
Right.
But in 2026, with the way AI has converged absolutely everything, those lanes are gone. They are stepping on each other's toes constantly.
They really are.
Yeah.
And to help us figure out who has the edge in this new reality, we have pulled together a massive stack of reports for this deep dive.
A very heavy stack.
Yeah, we're talking detailed equity research from
Okay.
DBS Bank, some really interesting strategic analysis from Chris Padilla, and trading key technical data from Capital.com, and of course the raw 10K and earnings filings from the companies themselves.
And we also have some macro context from D.A. Davidson and J.P. Morgan that paints well, let's call it a viscous picture of the economy right now.
Viscous is a very polite word for it. So here is our mission for today. We aren't just reading numbers to you, we are answering the big question. In this economic landscape of early 2026, where AI anxiety is a very real term and tariffs are shaking the market, which of these two giants has the structural edge?
Right. Is it the intelligent cloud of Microsoft, or is it the vertically integrated fortress of Alphabet?
That is the $3 trillion question. So let's dive in.
Let's do it.
Okay, before we judge the swimmers, we need to talk about the water they're swimming in. Because according to a report from D.A. Davidson dated just yesterday, February 23rd, 2026, the water is getting really choppy.
It is extremely choppy. D.A. Davidson is highlighting a very specific phenomenon happening right now, which is a rotation. We are seeing a 2026 equity market rotation away from technology and growth leaders.
Which feels kind of counterintuitive, right? I mean, we spent the last 3 years thinking tech was the only lifeboat in the ocean. Why jump off now?
Because the lifeboat is getting expensive and people are worried it might have a leak. D.A. Davidson points out that software stocks specifically are leading market declines right now. And the reason they give is fears of potential AI disruption.
Okay, so this is that AI anxiety we mentioned. But is that anxiety that the AI will, kill us?
Sure.
Or anxiety that the AI will kill the business model?
It is definitely the business model they are worried about. Think about it. From 2024 to 2025, the narrative was just AI hype. It was all, look at this cool demo, look how fast it writes code.
Yeah.
Now investors are asking a really deflationary question. They're saying, wait, if AI makes coding 50% more efficient, do you need 50% fewer software licenses?
I see. So if I'm a big enterprise client and Microsoft's Copilot makes my developers twice as fast, maybe I don't need 5,000 seats of Visual Studio anymore.
Exactly.
Maybe I only need 2,500.
Precisely. That is the fear. Investors are pricing in vulnerability now. They aren't impressed by promises of efficiency anymore. They are terrified of demand destruction. They are demanding proof that AI actually grows revenue, not just shrinks the workforce.
And it's not just the tech existential crisis we're dealing with. It's the political headwinds, too.
Right.
We have to talk about the tariffs.
We do. This is a major factor in the D.A. Davidson report. They note that equity markets are weaker right now due to tariff certainty being jarred.
Right.
There was that recent Supreme Court ruling regarding emergency reciprocal tariffs that has just thrown a wrench in the works.
Yeah, the report mentions that uncertainty returned as tariffs were raised to 15%. They had been at 10%, but that bump to 15% is weighing heavily on equities across the board.
And think about what that does to a hardware supply chain. If you are Microsoft or Google and you are buying billions of dollars of servers and GPUs and massive cooling systems, A 5% jump in tariffs is not a rounding error.
No, it's a massive hit.
It is a massive hit to capital expenditure. It creates incredible friction in the entire system.
Vanguard actually weighs in on this too. In their global outlook for 2026, they characterize this year as being defined by gradual tariff inflation. It's a slow burn, but it basically heats up everything.
And then you have JP Morgan dropping a really provocative thought in their mid-year outlook. They suggest that AI might actually strain the economy before it booms.
That stuck out to me too. Usually we just hear AI equals productivity equals economic boom.
Right. But JP Morgan argues that AI might suppress demand before the productivity gains are really felt by the broader economy. It's a classic J-curve effect.
Explain that a bit more.
So if AI displaces workers or creates efficiency that reduces the need for existing services, you might see a dip in aggregate demand, meaning spending goes down before the new wealth is actually created. Things get worse before they get better.
Wow. So that is the backdrop. We have tariff inflation, we have investors getting skeptical of software, and we have a potential economic strain from the very technology these companies are pushing.
The rising tide lifts all boats era is completely over. Now fundamentals matter a whole lot more than stories.
Okay, let's look at the first titan, Microsoft Corporation, ticker MSFT.
The giant of Redmond. The safe bet. Or at least that's what we've always been told, right?
Right. We're looking at a report from DBS Bank dated January 26, 2026. And they are pretty bullish, actually. They still have a strong BUI rating on Microsoft.
DBS is looking at the core engine of the company here. They identify intelligent cloud plus gaming as the leaders of growth. And when you look at the numbers, it's really hard to argue with their optimism regarding the sheer scale of the operation.
Let's look at those numbers. According to Microsoft Investor Relations for FY25 Q4, they reported strong revenue beats driven primarily by that cloud growth. But DBS takes it further. For the fiscal year 2026, they're forecasting sales of approximately $457.8 billion.
That is almost $500 billion in revenue. That is a GDP-sized number. But you know, revenue is vanity, profit is sanity. What always impresses me with Microsoft is the margin. DBS projects an EBITDA margin of 46.3%.
Okay, pause there. For the listener who hears EBITDA and just glosses over it, break that down. A 46% margin. Is that good?
It's spectacular. Think about a normal business like a grocery store. They operate on maybe a 2 to 4% margin. A car company might be thrilled with 8 or 10%.
Right.
Microsoft is keeping nearly 50 cents of every single dollar they bring in before they pay interest taxes, depreciation, and amortization. It shows the immense power of their software margin structure. They're essentially selling water in a desert.
And their return on equity, or ROE, is projected at a robust 31.6% for FY 2026. So they are incredibly efficient with their shareholders' money, too.
Extremely efficient.
Yeah.
But we do have to talk about the product actually driving this. It's not just Word and Excel anymore. It's Copilot.
Copilot. You really can't escape it. It's in Windows, it's in Surface laptops, it's baked into the entire stack.
Microsoft's strategy has been ubiquity. They want AI to be like electricity, just running in the background of everything you do. But there is a hiccup.
Yeah, I saw this in the InfoWorld report. They noted that the push for Copilot for organizations and personal use has, quote, irked customers.
It's the Clippy problem all over again, but way smarter. There's a very fine line between a helpful assistant and intrusive software bloat. InfoWorld mentions that this aggressive integration has even stirred interest from the FTC.
That is never a good thing. When the regulators start asking why your AI is impossible to turn off, that's a real risk.
It is, because they start using words like monopolistic tying. If the FTC decides to unbundle Copilot from Windows, that massive growth engine could seriously sputter.
But despite that, the investment thesis remains very strong in these reports. Morgan Stanley, in another report we have here, forecasts a 38% upside for Microsoft stock.
That is a very significant upside for a company already this large.
Let's talk price targets. DBS has a 12-month target of $678. Now, depending on exactly when you pull the quote, our sources have the current price around $389 to $451, depending on the volatility of the week. We have to acknowledge that volatility, but $678 is a massive jump.
It implies they believe this revenue realization phase is going to go very, very well for Microsoft. The consensus recommendation across the board is a solid BUI.
What about the valuation? Is it too expensive?
It's not cheap. It's trading at a forward PE of roughly 27.7 to 28.2 for FY 2026.
So you're paying about $28 for every dollar of expected earnings.
Correct. Historically, for a mature tech company, that is a premium, but for an AI growth company, it might be totally reasonable. However, remember that AI anxiety we talked about earlier.
Yeah.
It specifically targets high valuation software stocks. If the market decides that 28 times earnings is too rich because AI is going to disrupt software pricing generally, if they decide Microsoft is going to become a utility and not a high growth stock, Microsoft has a long way to fall.
Oh, and they also have a dividend yield of roughly 0.8%, just to throw that in.
So the bull case is they own the enterprise. The cloud is growing and margins are huge. The bear case or the counter thesis is that it's too expensive. Customers are getting annoyed by Copilot and the FTC is watching closely. And don't forget execution risk. Can they maintain that cloud growth trajectory in a tariff-heavy environment? If those tariffs hit their massive server costs, can they pass that on to customers without losing market share?
That is the Microsoft picture. A fortress, but maybe a slightly expensive one with some regulatory cracks in the mortar?
I think that's a very fair assessment.
Okay, let's just unpack this for a second. We've got Microsoft, the safe cloud giant. But before we switch gears and dive into Google, or Alphabet, I should say, I want to take a brief second to talk directly to you, the listener.
Because we know exactly who you are. You're the person who wants to know why things are happening in the market, not just what happened.
Exactly. We spend hours combing through these dense 10Ks, these massive bank reports from DBS and JP Morgan, the technical charts from Capital.com. You do it so you don't have to. We are your shortcut to being the most well-informed person in the room.
But we do need your help to keep doing this.
So here is the ask. If you are enjoying this deep dive into the numbers that actually matter, hit that subscribe button, like the show. And more importantly, drop a comment right now. Based on what you've heard so far about the economy of Microsoft, are you Team Microsoft? Or are you holding out for Team Alphabet?
I'm really curious to see the split on this. That AI anxiety factor might really drive people into different camps this year.
Let us know in the comments. Okay, moving on. Let's bring out the red corner. Alphabet Inc. Tickers GOGG and GOGL.
The company that literally knows everything.
We have a report here from TradingKey dated January 27, 2026, and they make a very bold claim. They highlight Alphabet not just as a good stock, but as the premier investment among the mega caps because of their unmatched ecosystem.
That is a strong statement, given how well some other tech giants have done. But their argument is fascinating. It basically comes down to two words: vertical integration.
Break that down for us. What does vertical integration actually look like for Alphabet in 2026?
Think about the AI stack like a sandwich. To serve you an AI answer, you need 4 layers. First, you need the chips. Second, you need the cloud to put those chips in. Third, you need the data to train the models. And fourth, you need the model itself.
Okay, makes sense.
Microsoft has the cloud with Azure and the model via their OpenAI partnership. But they rely heavily on outside vendors for hardware. They are paying a huge tax to outside chip makers every time they buy a GPU.
And Alphabet.
Alphabet owns the whole sandwich. They have their own custom chips, the TPUs or tensor processing units. They own the cloud with GCP. They own the data because Search and YouTube are arguably the biggest proprietary data repositories on Earth. And they own the model, which is Gemini.
So they basically don't have to pay that middleman tax.
Exactly. TradingKey argues this makes them a financial fortress. Because they make their own chips, their cost to run AI, what we call the inference cost, is structurally lower than Microsoft's.
That sounds like a massive long-term advantage. If AI becomes a commodity, the lowest cost producer wins. And speaking of a fortress, look at their cash pile from the Q4 2025 data.
I was looking at that. It is absolutely staggering. Cash equivalents, and marketable securities stood at $126.8 billion.
$126.8 billion just sitting there. It's up from $95.6 billion the prior year. That is a serious war chest.
In a world where capital can get expensive, having that much cash is a weapon. If they need to build new data centers, they just write a check. If they need to push through a tough economic cycle, they have the buffer.
And the revenue forecast from DBS for FY 2026 is $457.8 billion.
Wait, did you catch that number?
What?
Microsoft's forecast was $457.8 billion. Alphabet's is $457.8 billion. They are quite literally neck and neck on the top line.
That is wild. They are virtually identical in sheer revenue scale.
But look at the margins. Alphabet's operating margin stood at 38.5% in Q3 2025. Very strong, but lower than Microsoft's 46% EBITDA margin.
Why the big difference there?
It comes down to hardware costs, traffic acquisition costs, like, paying Apple billions to be the default search engine on the iPhone and their Other Bets division that just structurally burns money. But 38.5% is still incredible for a company that size,
And they're paying a dividend now. They declared a cash dividend of 21 cents.
which signals maturity. They are essentially saying, we have so much cash here, take some back.
Let's talk about the segments. Google Services is obviously the cash cow search and YouTube, but Google Cloud is the really interesting one right now.
Trading Key notes that Google Cloud is actually growing faster than AWS and Azure in percentage terms. It's showing the fastest revenue growth among the big three right now.
That's a huge deal. For a long time, Google Cloud was just this distant third. If they are accelerating, that really changes the narrative.
And it links right back to that vertical integration. If you use Google Cloud, you get access to those custom TPUs and Gemini in a way that is incredibly seamless and cost-effective. It's heavily attracting startups and big enterprises.
Now let's look at the valuation. Trading Key calls Google a neutral play that offers startup-like growth with established stability.
They explicitly state that Alphabet has a better valuation compared to Microsoft's higher multiples.
The numbers definitely back that up. Their forward PE is around 27 times.
It's slightly cheaper than Microsoft, and when you factor in that massive cash pile, their enterprise value might look even more attractive to value investors.
DBS has a 12-month target of $360 for Alphabet.
Yeah.
And the current price is floating around $310 to $338. So very decent upside there.
And it's rated BUY as well, but we have to talk about the elephant in the room for Alphabet.
The sword of Damocles.
Antitrust.
Yeah, Wilson Sonsini reports 2026 is a massive year for antitrust enforcement. And there's a specific case mentioned, the Price Runner antitrust damages case.
It's nearing a verdict, and that's just one piece of the puzzle. Google is fighting on multiple fronts. The DOJ wants to break up their ad tech business. The EU is constantly coming after them. Microsoft has regulatory annoyances with Copilot, but Google faces potential existential threats to its entire business model.
And then there is the search behavior risk.
This is the one that really keeps me up at night if I'm a Google shareholder. The risk of users shifting their behavior from traditional Google search to AI chat.
Right. Instead of Googling best Italian restaurant, I just ask an AI chatbot.
And if you do that, you don't see Google's sponsored links. Now, Google is obviously hedging this heavily with Gemini. They are putting AI right into the search results. But that fundamentally cannibalizes their own highly profitable ad inventory. It's the classic innovator's dilemma. They basically have to destroy their own golden goose just to save it.
So Microsoft is the expensive, safe enterprise giant. Alphabet is the cash-rich, vertically integrated powerhouse, but it's under siege from regulators in a completely shifting user behavior landscape.
That is exactly the setup.
So we've looked at them individually. Now let's make them fight. Section 4. We have a report from Chris Dia that analyzed both companies for a structural edge in 2026.
Chris Dia really drills down into the comparative advantages here.
Their verdict. They say Microsoft is a core holding, but they argue Alphabet offers more immediate upside potential.
And they cite that valuation edge we just talked about and that deep structural integration.
Let's go back to that hardware independence thing.
Yeah.
How big of a deal is this really when we compare them directly?
It's huge. In 2026, inference, which is the actual running of the AI models day to day, is the biggest cost center. If Google can do it significantly cheaper because they designed the chip specifically for their own model, that is a massive structural moat. Microsoft is more reliant on partners like OpenAI and external hardware, and that inevitably impacts their margins down the line.
But Microsoft clearly has the lead in the cloud wars in pure volume, right?
They do. Microsoft's intelligent cloud is massive. The absolute revenue is larger. But the acceleration is on Google's side. Also look at RPO, their remaining performance obligations.
That's basically the backlog of signed contracts.
Yes, exactly. The RPO for Google indicates incredibly strong future enterprise commitment. Big companies are signing massive long-term deals with Google Cloud now. They aren't just testing it out with small workloads anymore.
There is another difference in the comparatives that I found really fascinating. The ownership battle.
Oh, this is a governance nerd's favorite topic.
According to the Motley Fool Alphabet's founders, Larry Page and Sergey Brin still control approximately 51.4% voting power via their Class B shares.
They own the company, period. Institutional investors are basically just along for the ride.
Whereas Microsoft is institutional heavy, Vanguard, BlackRock, and so on.
Right. Microsoft is a normal corporate entity. If the leadership stops performing, the board, pressured by those institutions, can replace them.
But that Alphabet.
At Alphabet, if the founders want to spend $10 billion on a moonshot project that makes zero short-term financial sense, nobody can stop them.
Is that a bug or a feature in 2026?
Yeah. Honestly, it might be a feature right now. because AI requires massive, risky long-term bets that might absolutely crush quarterly earnings. A founder-led ship can take those bets without fearing an activist investor revolt. Microsoft has to answer to the quarterly drumbeat a little bit more carefully.
That is a fascinating dynamic. Alphabet basically has a founder shield.
It cuts both ways, though. It
Yeah.
can lead to a severe lack of accountability, but in a platform shift, this violent, I almost lean toward the benevolent dictator model being slightly more agile.
Let's talk about the charts. We have some technical analysis from Capital.com for the traders out there. What are the key levels we're looking at?
For Microsoft, Capital.com identifies a key pivot point at 473.
473.
Yes. If the stock closes above 473, the technicians say it opens the door straight to 516. That is the major breakout zone.
And the downside.
Downside support sits at 447 and then a harder floor at 404. The stock forecast suggests their AI strategy could lift the overall outlook, but technically speaking, it is currently testing key resistance. It's kind of banging its head against the ceiling right now.
What about Alphabet's technicals?
Alphabet has recovered incredibly well since the 2022 downturn. The momentum is labeled as a strong buy by technical analysts, and targets were broadly lifted following those strong Q4 2025 results.
So technically, Alphabet feels like it has the wind at its back, while Microsoft is trying to punch through a tough ceiling.
That's exactly what the charts are telling us today.
Okay, we've covered the macro, the fundamentals, the structural edge, and the technicals. Now let's pull out the crystal ball for Section 6, predictions and future outlook.
Let's talk price predictions for the rest of 2026.
We mentioned Capital.com and DBS. Both see Microsoft breaking the $500 mark and potentially reaching that 678 level in a highly bullish scenario.
That would push Microsoft well past the $3 trillion market cap and start knocking on the door of, dare I say it, $4 trillion?
Some sources are even throwing around the trillion-dollar race pass to $5 trillion.
It sounds totally absurd, but with inflation and these aggressive growth rates, it is mathematically possible in the coming years.
And for Alphabet, DBS sees it moving steadily toward 360.
Which is a solid, steady gain. It's maybe less explosive than Microsoft's bull case, but arguably less volatile if they can navigate the courts.
What are the big future events we need to watch? What triggers these massive moves?
Two main things. First, revenue realization. 2026 is the year companies must show ROI on all this AI CapEx. If Microsoft's Copilot doesn't pay off for clients, if companies realize it's not boosting productivity enough to justify the cost, the stock could severely suffer. JP Morgan specifically warned about this.
Right. If the software doesn't pay for itself, the enterprise renewals just won't happen.
Exactly. And for Google, it's regulatory verdicts. If the outcome of these massive antitrust cases goes poorly or forces a breakup of the ad stack, that stock price will react violently.
Do you think that reaction would be positive or negative?
Paradoxically, a breakup could actually unlock value. Some of the parts analysis often shows that Google's individual pieces like YouTube and Cloud are worth more than the whole conglomerate, but the uncertainty would be extremely painful in the short term.
So we basically have a year of proving ROI and dodging gavels.
That sums up 2026 perfectly.
All right, we've covered a ton of ground today. Let's try to summarize this for the listener.
Okay, if you are looking at Microsoft, you are looking at the safe cloud giant.
They have a high valuation, a massive enterprise moat, and incredibly deep AI integration.
But they are facing serious AI anxiety, high market expectations, and potentially irritated customers.
And if you were looking at Alphabet, you're looking at the value tech titan.
Cash-rich, vertically integrated from chip to model and sporting a cheaper valuation.
But they are completely hounded by regulators and fighting a desperate war to defend their core search business.
It really is a choice between premium price stability and discounted structural power with massive regulatory risks.
Before we sign off, we have to do the responsible thing. We aren't financial advisors.
No, we are definitely not. And we need to remind everyone about the risks. Capital.com statistics show that 81.31% of retail investor accounts lose money when trading CFDs. That is a very sobering number.
Yeah, that is 4 out of 5 people losing money.
Exactly. And Moody's highlights broad credit risks for 2026. All the sources we use today emphasize that past performance does not guarantee future results. This is strictly analysis, not financial advice. Please do your own research.
Read the 10 case.
Yes.
I want to leave you, the listener, with one final provocative thought to chew on. Something to explore on your own.
Let's hear it.
We talked about JP Morgan's idea that AI might suppress demand before it booms.
Right, the J-curve.
If AI makes us all so incredibly efficient, we simply need less software. Say one person with Copilot can do the work of 3 people, so a company buys way fewer licenses. Who loses the most?
That is the ultimate question.
Is it the one selling the software seats, which is Microsoft? Or is it the one selling the ads to the people using the internet, which is Google?
If people are working less because of extreme efficiency, are they sitting at home consuming more media? Maybe Google wins that scenario. But if companies shrink their workforces, they definitely buy fewer software licenses. Microsoft loses there.
Well, wait, if companies shrink, they also have smaller budgets to buy ads.
Touché. It is a completely tangled web.
It certainly is. And that is exactly why 2026 is going to be one of the most fascinating years in market history.
I cannot wait to see how it all plays out.
Thanks for diving in with us today. We'll see you on the next deep dive.
See you next time.